Let's do our calls of the day. And we're going to start out with Barron's talking about Berkshire Hathaway. Looks pricey after its record run above $1 trillion. It's trying for its 10th straight day of gains, by the way. Fresh all-time high on Wednesday. What do you think about this note from Barron's?
So I obviously am a long-term shareholder here and a long-term bull, but I actually agree with what Andrew Barry is saying in the article. It's short-term overbought. Like, this stock is acting like they're doing AI in Omaha. I don't think they are. Obviously, they're benefiting from the big Apple position. They're also benefiting for the enthusiasm around AI and utilities. They're, I think, the second largest utility in North America. They're also benefiting from the economy and, of course, the railroad and all the home building stuff. So there are so many reasons why the stock has become overbought. But I think these money shots from the article are the ones to focus on. If you're about to make your first purchase ever into Berkshire, maybe now is not the best time. It's 1.7 times book as of at the end of the last quarter. That's the highest it's been valuation-wise over the last 10 years. The other thing to keep in mind is even Berkshire isn't buying Berkshire. So they have a buyback. It's not a big part of the story. They only bought back $345 million worth of stock last quarter. When you consider that the prior quarter they bought back $2.6 billion worth, even they don't see as much value in buying the stock here. So I own it. I'm long. I'm probably never going to sell it. But if I were about to buy it today, I might wait a minute just because of how popular of a trade. This is the second highest RSI of the S&P 100. The only more overbought stock is Walmart right now. So, like, just I know you feel like you missed it. I get it. I've been there. Just relax. I feel like there'll be a better opportunity.
You know what I find so interesting is how you frame that in the greater context of they apparently don't see much value in anything right now. Mountain of cash, selling some Apple at near its high, not even buying their own stock. So that, to me, is a greater statement than when we were talking on August 5th. Hey, what does Berkshire see? They're selling half of Apple. Should we be concerned? Because that was one of the things that you could put in the pie that caused the whole upset in the market. It was the jobs report. It was Berkshire selling half of its Apple position, and then it was Japan. You just hit what I think is a really interesting point. They're not even buying their own stock.
That's right. When they first started, first of all, there's a school of thought out there that's like, all right, it's time for dividends at this point. They still won't do it. Okay. So part of their shareholder return is returning capital via buybacks. When they first initiated the buyback, they said there would be some ratio to book value. I don't think they look at that as being the right way to do things anymore, because based on that original ratio to book value that they set out, they would basically never have a chance to buy stock the way it's being valued. Like, there would just be that guardrail would keep them from ever buying. So they loosened up on that. They've done some buybacks over the past couple of years. These are not big numbers. When you talk about a $1 trillion company, and we're talking about $300 million worth of buyback activity in a quarter, it's not terribly material. Maybe in the aggregate over time. But Scott, I think you're right. It's like they can earn 5.25% risk-free. There's no urgency. There's no urgency.
Financials have ripped this year. They're selling Bank of America.
Taking profits.
It's like you just go down the checklist, and it makes for interesting fodder, if nothing else. GE Aerospace and Dupont. Top industrial picks at UBS. Stephanie Link, you own both.
I do.
GE bigger than many other positions that you have. But what about this call?
Yeah, I mean, GE is a top 5 position for me. It's up 60% year to date, so I'm not sure I would chase it here. But, you know, they have a simpler company now. They have done the spin-outs, so that's a positive. They're the #1 engine maker. They have pricing power in the mid-single digits. They've got margins. They've got free cash flow. So they're hitting on all cylinders, and it's led by a great leader and team. And so I like it. I just don't know if I would buy it. Dupont, it's just about the spin. The spin's going to come in about 18 months, so we've got time. But in the meantime, the electronics business is actually bottoming. 3M told us that too, by the way. And they had double-digit volume growth, margins, and better free cash flow because of the bottoming in electronics. So I like both of those positions very much.
They go GE $215, and they say Dupont $104.
Hope so.
And again, both rating a buy. Target, you want to talk about that? Because UBS as well says it's their top consumer pick right now. $200 is the price target.
See, I think there are haves and have-nots in retailers. I wouldn't touch a department store or a dollar store. But I think Walmart, Costco, Target are the leaders, as well as Amazon, of course. Target, actually, they've done a lot of changes over the last couple of years, and it's starting to help them in terms of products and pricing. And their comps were 2% in the quarter, much better than expected. Traffic grew 3%. I think they can earn something like $10 this year a share. That makes this stock a pretty cheap one, and it's lagged these other three that I mentioned. So I like it very much.
All right.